Hi, everyone. I'm Vladimir Duthier.
And I'm Christine Johnson. World financial markets are continuing to slide as anxiety grows about China's economy. Today's plunge came after an abrupt halt to trading on the main Chinese stock market following a sharp sell-off.
Here in the U.S., the Dow Jones is currently down more than 200 points. This latest blow came after China's so-called circuit breakers automatically triggered for the second time this week. It all happened within 30 minutes of trading, making it the shortest day in the index's 25-year history. Let's go first to the floor of the New York Stock Exchange, where Hena Daniels is now to see how China's halt is continuing to impact Wall Street. Hey, Hena.
That's right, guys. Hey, Vlad and Christine. While the declines are not as bad as expected, at this hour, the stock market tumbled right from the opening bell, with the Dow Jones dropping hundreds of points within seconds. Now, the trouble continues to spread from China, like you mentioned, where circuit breakers suspended trading after the stock market lost more than 7%. Weakness in the world's second largest economy has reignited concerns about a global slowdown. Joining me now to talk about it all is Tim Anderson, Managing Director of TGAM Investors, and thank you so much for joining us.
Thank you for having me.
Now, it's been a rough start on Wall Street this year, in the new year. Why?
Well, for a number of reasons. I mean, you mentioned China. There's anxiety over whether or not things are going to get as volatile as they got last summer. Certainly the increased tensions between Saudi Arabia and Iran are, put a whole new level of uncertainty on what might take place in the Middle East. Our market may have been a little artificially propped up toward the end of the year. We had a 70-point rally on the S&P 500 from December 18th until the 29th. But right now, I think investors are a little bit nervous about fourth quarter earnings starting to hit next week. We're very likely going to have the fourth consecutive quarter of declining revenues for the S&P 500. I mean, that's clearly not a good trend. A lot of people will try to one-off it saying it's all energy, but it is what it is.
And a few minutes ago, we were talking about China's circuit breakers. Why does that have such a huge effect on us here?
I think it has a psychological effect more than a real effect. Frankly, when you have a major global market that's only open for 30 minutes, and because circuit breakers kind of shut the whole thing down, regardless of what the intentions were, it's just not the way big institutional investors are used to operating in the market. Now, they've lifted that, and there's going to be no circuit breakers tomorrow, so it'll be fascinating to see how the market reacts. You would certainly think that they're ready to back up the truck through their state-operated investment vehicles and prevent a real sharp sell-off.
And speaking of market, this morning when the opening bell rang, the Dow tumbled hundreds of points. Right now it seems pretty steady. Why the change so quickly?
Well, I think the fact that China said that they were going to lift their circuit breakers for the rest of the week, being tomorrow, was a little bit of a positive. And also, crude oil was down over 3% to start the day. And crude oil had rallied back from that level, went slightly positive maybe about an hour and a half ago, and right now it's just slightly negative, but that's still much better than a 3% decline.
Tim, thank you so much for putting it in all context. And right now, guys, futures are pointing down, so it'll be interesting to see what happens when the bell closes later on today.
All right, Hena Daniels at the New York Stock Exchange. Thanks, Hena. Let's go ahead and bring in Yahoo finance columnist Rick Newman for some analysis. He's joining us as well. Rick, what is the big fear here when it comes to China? Obviously, the second largest market in the world. This is happening twice in 1 week.
I think the real fear is that there's some hidden problem in China. It's no secret that the Chinese economy is slowing down. It's still growing. It's probably going to grow at 6% or 6.5% this year. But this is an economy that's been growing at 9 or 10% and in double digits before that. The concern is that there are sort of unseen problems there. We know they have kind of a credit bubble. There's too much debt. That mostly affects companies that are in the manufacturing sector related to real estate mostly. How bad is that? Is it going to be contained to just part of China's economy, or is it going to turn out to look like something like the U.S. housing bust in 2008? I think that most economists will tell you we don't think the problems in China are really that severe. It's kind of the unknown that I think is freaking the markets out right now.
And speaking of the unknown, there's been a lot of talk about these circuit breakers. The fact that they've now halted those and basically unplugged them so that tomorrow trading will begin once again. How much of a factor do you think that plays in this?
I think the biggest issue with those circuit breakers and the way regulators in China in general have been trying to oversee the stock market is that they keep changing the rules in the middle of the game. I mean, nobody has confidence in referees who change the rules in the middle of the game, and that's what's happening in China. They don't have a fully developed stock market the way we do here in the United States or they do in Europe. They are sort of building up this market, and they're trying to gradually expose it to free market forces and free market principles. But they also want to retain some control over it, which is why we're seeing this stutter step effort. The circuit breakers are on. They close trading for most of the day because they hit the limit in the first 30 minutes of trading. So everybody goes home when they're supposed to be trading stocks. I mean, that's kind of ridiculous. So now they've said, okay, that didn't work. Let's try something new. Let's try it without the circuit breakers. Nobody has confidence that the authorities in China overseeing the markets really know what they're doing because they keep changing everything.
Rick, the question I think a lot of investors here in the United States are going to have is, how is this going to affect my portfolio? When you look at the long-term fundamentals of the U.S. stock market, the U.S. economy, I mean, the banks are not as leveraged as they were. The deficit seems to be under control. Auto sales are exceeding expectations. We're expecting a pretty good jobs report tomorrow. I mean, when we talk about the long-term fundamentals of the United States, I think we're in pretty good shape.
Thank you for saying that. What's happening in the U.S. markets right now seems almost completely disconnected from what's happening in the U.S. economy. And I think that's because we really don't have anything big going on in the U.S. economy right now except steady as she goes. So, we got through the big Federal Reserve interest rate increase, a grand total of a percentage point in December. That's what all investors everywhere in the world were looking at. So now that we don't have that as a focal point, people are kind of looking around for what are we supposed to be paying attention to now? And suddenly trouble bubbles up in China. So that has been influencing the markets. The analysts are saying this is a little bit crazy. What's happening in China is having a totally outsized effect, disproportionate effect on U.S. markets. It doesn't reflect anything about the fundamentals of the U.S. economy, which look pretty good at this point. So if all that is true, what that means is the markets here should bounce back because the U.S. markets still mostly reflect the U.S. economy and the economy in the developed world, that's United States and Europe. China is a factor, but not as big a factor as it's been playing recently.
You mentioned interest rates, Rick, and there has been some suspicion that the Fed will continue to raise those as we move on through the year. How much of a factor will that play?
Well, it's not suspicion. I mean, the Fed itself has said, basically said, we do expect to continue raising interest rates very gradually. So I think that will affect markets to the extent that the Fed either does what it said it's going to do or does something different. So if the Fed basically does what it said it would do, which is very slowly and very gradually raise interest rates, I think markets will probably be fine with that, barring any other sort of unforeseen shock. But if the Fed does something surprising in either direction, that will upset markets for sure. If they raise faster than they've telegraphed, that's going to upset people that the Fed sees inflation coming or the Fed got behind the curve or something's wrong. And if they were to lower interest rates again, and there's not much they can do to lower them, but they could lower them by that one chunk, that would tell the markets that the Fed sees the Fed thinks something's wrong. So I think the Fed just needs to do what it said it will do, and everybody will feel okay about that.
Rick, let me ask you a question before we go. Donald Trump, in an interview with the New York Times editorial board, said that if he were president, he would impose a 45% tariff on goods coming into the United States from China. As an analyst, as a reporter, as somebody who covers the markets, I mean, what is your analysis on that? Because those goods that are coming into the U.S. are cheap, and so Americans are able to buy them. If you make those goods expensive, that's really not going to be, that's going to be detrimental to us here in the U.S., isn't it?
It's a great soundbite and a total political loser. So if a president's going to say, I'm just going to arbitrarily raise the price, significantly raise the price of the TVs you buy, the iPhones you buy, the cars you buy probably, because, I mean, almost everything we buy, he just says, I'm just going to raise the price of everything because I don't like China.
Right, because I want to be tough.
Yeah, that's just going to go nowhere. So I think it's politically impossible, honestly. I don't think a president could get away with that unless there were some much more problematic circumstances that we have now. Everybody wants to talk tough about China, but you know the cheap goods are generally good for the United States, and consumers love the cheap goods. So you can't do that to voters.
All right, Rick Newman, thank you very much, Rick. Appreciate it.
Sure thing.